isn't working? Let's ask a different way to approach this challenge, approach this discussion. What, in all of your experience, I mean, Jeff, I know it's only been a couple months, but you're moving fast, so it probably feels longer than that. What in your times running this organization have you seen just didn't work, was really hard and you struggled with and had to take a different approach? What is the number one challenge in trying to operate a green bank?
Well, the infrastructure bank, I guess it's a couple things. One, the old agency was pretty old-fashioned and everything was done by hand. So we're undergoing a technological transformation of the bank. At the same time, we're putting in all these new programs. So the workload is pretty heavy. But I think one of the biggest things that we found is getting the word out. We've got a lot of different programs, whether it's cesspool remediation, sewer tie-in. We'll now have residential pace, soon commercial energy efficiency building fund. All these are new programs that the biggest challenge I think we have is just making people understand what it is that we have available to them. And really, historically, we've been organized around programs and products, and we've not been organized around customers. Coming from the private sector, we're looking at organizing yourself around the customer's needs and what programs do you have that you can bring to bear. I think that's been our biggest challenge, is really getting the word out and figuring out who our customers are, who the channels are to get to those customers, whether it's contractors, real estate agents, home lenders, whatever. How do we get the message out, and how do we create the demand for the products that we have?
Mary, how about you?
So one of our challenges is that we are credit score based on our residential program. So the minimum credit score is 640 and the debt to income ratio is 50%. We serve we approve about 65% of the applicants. That still means there's 35%. And when that translates into real people, that's like 4,000 people that over the last 4 years have wanted to do energy efficiency work. We've done all the hard work to get them to the table where they're ready to spend some money. And that's a lot of hard work to get them there. And then we have to deny them. And we've tried to create other programs that once they're denied, then you move them into another program that might be funded through other sources, but those have been very complicated and they haven't worked really well. So we're looking at that really, really closely right now to see if we can continue with our leverage ratio, which is really strong. We have a 5% loss pool cap, so we're leveraging our public dollars 20 to 1. And if we can keep that structure in place and start to move down and serve more and more people without creating more defaults, which, we'll see, but that would be able to allow us to serve more people. We're working right now with a pilot in one of our small cities in Holland, Michigan, to do an on-bill repayment program. We're looking at using utility, 12 months of consistent utility bill payment history as the underwriting criteria. And we're hoping that we can get down into that market just a little bit more, and we're hoping that we're not going to impact our capital.
Have you, this is interesting, have you talked to your current set of lenders about their level of comfort of moving down credit scores without asking for more credit support?
Yeah, we have, and they're open to it. They're also open to perhaps doing some pilots on bill, which is really, if we can get some private capital involved in that and not use potentially the utility capital, that's going to be really strong. They're interested, the interest rates will be a little bit higher, which is fine. We don't have any problem with that. And so, yeah, they're interested. They're moving very cautiously, and we'll probably do some pilots this year to test that out.
Interesting. Bryan, what's been one of your challenges?
So I guess I would say that there's a balance, right, between clean energy finance, where you're part of a capital stack financing commercially available technologies, and then trying to be a catalyst in the market. There's that kind of risk that you always want to be a part of. You can't be afraid to fail, right? Wayne Gretzky, you miss 100% of shots you never take. And I think in the multifamily and affordable housing space, we're going to see, we've had some failures, programs that we've set up, taken a lot of time and effort putting together, and we've seen one transaction move into that market spot that we've given up on and exited and moved on. But I think that's the important part of trying to figure out these underserved markets, is we've got a whole portfolio now, a whole suite of programs. We're identifying partnerships with the Connecticut Housing Finance Authority, the Department of Housing. We're improving our relationships with the utilities. So if you don't lose or fail, then you really don't know what it is you're trying to shoot for. So the low-income space, multifamily space, we're going to lose, but in the end, we hope that we're going to be able to bring more clean energy to this market segment.
Alfred.
I guess one of the areas that we've put a lot of time into and haven't gotten transaction to closure yet has been energy efficiency and CHP around commercial and industrial and large commercial properties. And we think it'll happen. We're working with a number of ESCOs and specialty finance companies and boutique ESCOs and so forth that are targeting that market. And as some people in this room may know, it's a tough market. It seems like most of where we're seeing the activity are with MUSH counterparties rather than the C&I counterparties. We've spent a lot of time early on working with these specialty finance companies and ESCOs and boutique ESCOs, developing financial products, documenting that to be ready for this pipeline that is in place. But then it's a little bit of crickets, waiting for the transactions to actually close. These are long lead time transaction types, and it takes a long time for a large commercial property owner, I see some people nodding heads, to sign the dotted line to say, okay, we've agreed on these basic concepts, let's execute and start construction. So one thing we've done there is, rather than diving in so deep into the documentation, learning is to put forth a basic set of terms, say we're here to support you when the projects are ready to close. This is how we'll approach it, and push off a bit of that work until we actually have the projects to close around. And I think it's partly just realizing that these types of transactions have to go through a maturity period in the pipeline. And we should expect for these types of transactions, it may take 18, 24 months for a transaction to go from initial term sheet that a ESCO has with, or a contractor has with a building owner, to actually being ready to close. Now, I think the ESCO or the contractor, knowing the financing is there, gives them the leverage to go out and continue that work. But that's been a learning. It's not like Resi where someone can go transact at the kitchen table. It's a very long process, and that's been a learning for us as financiers.